is an example exercise for Chapter 9, which deals with absorption costing, and it also deals with our denominator level capacity. So first things first, what is absorption costing? Well, it's a rule required by GAAP that says for all of our fixed costs, we have to absorb some of those fixed costs into our inventory production. So on the left side we have variable costing. What if we only had to put in our variable costs? Well, we have a company here that made 8,000 units, but they only sold 6,000 of those units during the period, which means they have 2,000 left in their ending inventory. Well, if they sold those 6,000 units for $8,000 a piece, they would have generated $6 million in revenue. Let's assume they don't have any beginning inventory, and that the variable cost of manufacturing these goods would be $200 a piece. Well, if they produced 8,000 units at $200 a piece, they would have had $1.6 million in variable costs. And since they didn't have any beginning inventory, that would be their cost of goods available for sale. If they made 8,000 units and only sold 6,000 units, they would have had 2,000 left in inventory at the end of the period. If we multiply that by the $200 unit variable cost, we would be valuing our inventory in ending inventory at $400,000. Which means our cost of goods sold for the variable cost of production would be $1,200,000. Well, what if we had variable marketing costs? We can throw our variable cost of marketing in there at $185 a unit for the 6,000 we actually sold. Would be $1,110,000, leaving us with a contribution margin of $3,690,000. And from that, if we then subtracted our fixed costs both for manufacturing and marketing, we will come up with operating income of $1,230,000. You can use variable costing for internal documents. If you want to use it for managerial decisions, you can. You can choose to figure out the profitability of your products, your operating income, etc. this way. But for reporting purposes, you have to absorb, which is the right-hand numbers. Under absorption costing, we would still have $6 million in revenues, we would still have $0 in beginning inventory, we would still have $1.6 million of variable manufacturing costs, but now we would need to allocate our fixed manufacturing costs. If we made 8,000 units and each one cost $135 a piece, that would be $1,080,000 worth of fixed costs that we would have to put into the cost of our inventory. And if you look at variable, you can see that we took that same number out for our fixed manufacturing costs to get to our operating income. Now we're going to put it right into our inventory to determine our cost of goods sold. First, we need our cost of goods available, that is our variable cost plus our allocated fixed manufacturing overhead costs plus any cost we had beginning inventory, $2,680,000. Well, now our inventory, because we're putting fixed costs in, is costing us $335 a unit. $200 for variable costs and $135 for fixed costs, for a total of $335. Well, if we take our $335 that we are paying for each unit, our cost of production, multiply by the 2,000 units we have in ending inventory, that means that our ending inventory has a value of $670,000. Subtracting that from our cost of goods available for sale gives us cost of goods sold of $2,010,000, giving us a gross margin of $3,990,000. Now we would take out all of the costs of non-manufacturing expenses, which would be marketing in this case. So if we take out our variable and our fixed marketing costs, we come up with operating income of $1,500,000. So why does absorption costing have higher operating income than variable costing, and therefore why is it required by GAAP? It's because some of those costs that we are throwing into our inventory, some of those fixed costs that we are allocating, aren't going to end up in cost of goods sold. Why? Because we didn't sell them. So some of those fixed costs are being carried in our ending inventory. And since we have costs that are still on our books that we can't expense, we have to report a higher income. So again, this variable costing method is useful for managerial decisions. But for reporting purposes, you have to throw your fixed costs into your cost of production so that some of it gets expensed for what you actually sold, but the remainder of it sits in your inventory and therefore doesn't allow you to reduce your operating income to a lower level, therefore reducing how much taxes you have to pay. So enough discussion about that. Let's get to our actual problem. And for the problems, we need to determine our company's capacity to allocate out these fixed costs. Say we want to allocate out an equal portion to every single unit that we make during the period when we're budgeting. Well, we would budget, these are our expected costs, and these are the expected units that we expect to make during the period. So let's put out an equal portion to each unit. Well, how many units do you expect to make? You have three options, and it's called your capacity. The first capacity is theoretical capacity, and this, in summation, is how many units you could make if you went all out, working around the clock as fast as you can, with no concern for your own personal safety or repairing your machines or doing standard maintenance, and definitely no concern for customer demand. Can we actually sell these units that we're producing? We're just going through and making as many units as we possibly can, like it was some kind of race. That would be your theoretical capacity. Practical capacity is a similar concept, but now we're going to take into consideration we do need to repair our machines. We're going to have to shut down our plant. Most manufacturing facilities shut down for at least 1 week a year just so they can go through and make sure everything's up to safety protocol, make sure all of the machines are in operations, there's not a machine operating with a frayed belt that's ready to snap, all of that stuff. So manufacturing companies tend to have a shutdown period. This is also going to take into consideration machine setups. You have to set up your machine before you make each batch, so you can't just produce and produce and produce. You're going to have to let those machines sit idle and not producing for a little while so you can do a proper setup. Practical capacity, however, still ignores customer demand. We're not concerned if we can make these units. This is how many units we could make, considering we do have to do maintenance on our stuff, and we do have to operate fairly safely. If you want to take customer demand into consideration, that would be your normal capacity. So this reduces capacity by considering both those unavoidable interruptions that we had, as well as customer demand. Sure, we could make 1 million units, but can we sell 1 million units? If we can only sell 600,000 units, what's the point of making those extra 400,000 units? So normal capacity can be thought of as a firm's typical production level. Denominator level capacity is essentially which one of those three methods are we going to choose as the amount of units we could produce when we allocate out our fixed costs under this absorption costing method. And so for this example, we have Jacksonville Brewery. They are a first-year business, and they're going to manufacture craft beers. They have the same three options. They can choose their theoretical capacity, their practical capacity, or their normal capacity. Theoretically, Jacksonville Brewery thinks they could operate 358 days a year. People still need days off for holidays. They could operate 22 hours per day. You got to give people lunch. And they could produce 545 barrels per hour. Practically, however, they think they can only operate 348 days. They're going to have to shut down the facility at some point to do standard repairs, maintenance, safety inspections, etc. They also think they can only operate 20 hours a day, namely they're probably going to have to stop to set up machines, etc. And that they can only produce 510 barrels per hour at a safe level without someone injuring themselves. So that's the numbers they're going to use for practical capacity. For normal capacity, they still think they can operate 348 days a year and 20 hours a day, but they think they can only have the demand to warrant producing 410 barrels per hour. So theoretical, all out, as much as you could produce. Practical, taking into consideration maintaining your machines and safety. And then normal, taking into consideration both maintaining your machines and safety, but also how much you expect to sell. This is what Jacksonville Brewery is going to operate, and this is the other information that they're going to use to allocate out these fixed costs to their inventory. They're a new company, so their beginning finished goods inventory in both units and cost is going to be zero. During the year of 2018, they produced 2,670,000 barrels of beer, and they ended the year with 210,000 of those barrels in inventory, which have yet to be sold. They had actual variable manufacturing overhead costs, all of the yeast, barley, water, rice, whatever else goes in their wooden barrels, of 80,634,000. They had actual fixed costs of 26.7 million, and during the year they sold beer at a selling price of $47 per barrel. Now we need to figure out our budgeted denominator level. Again, we're going to allocate out these fixed costs evenly among all of the units we expect to produce. Well, what is our expected production? Theoretically, we could operate for 358 days a year at 22 hours a day, making 545 barrels of beer per hour. So theoretically, we could produce, if we multiply these three numbers together, a whopping 4,292,420 barrels of beer during the year. Practically, however, we can only operate for 348 days. We can only operate 20 hours a day, and we can only safely produce 510 barrels per hour. So our practical denominator level, our practical amount of units we think we can make, is 3,549,600 barrels of beer. And then normally, still 348 days of production per year and 20 hours per day, but we think we only have demand to make 410 barrels per hour. That's our optimum production level, which means if that's the case, we would only make 2,853,600 barrels of beer during the year. So how much will we allocate to the barrel? Well, at the beginning of the year, someone went through and said, what do we think our fixed manufacturing overhead costs are going to be? A smart person came up with a number of $27,900,000 given in our information. So let's bring this on down. And this does not change based on your theory or on your capacity level that you're choosing. So it's $27,900,000 we're going to allocate out to our inventory regardless of what capacity we choose. Our denominator level capacity, well, we just figured that out on the last chart. We think theoretically we could make 4,292,420 barrels of beer. However, practically we could only make 3,549,600 barrels of beer, and honestly, we think we only have customer demand to justify making 2,853,600 barrels of beer. Well, if we take our budgeted fixed overhead and divide it by our denominator level capacity, that's how much fixed overhead we would allocate to each barrel. So theoretical capacity, we'd be sending out $6.50 per barrel. Practical, we'd be allocating $7.86 per barrel, and normally we have $9.78 per barrel. So choosing your capacity chooses how much overhead you're going to allocate out to each barrel that you produce. How about our variable overhead costs? Well, we can see from our information that we had actual variable overhead costs of $80,634,000, and we had an actual production level of $2,670,000. Well, if we go and we fill in our actual variable overhead costs and our actual production level, that's not going to change based on what capacity we choose. So regardless if we choose theoretical capacity, practical capacity, or normal capacity, we're going to allocate $30.20 to each barrel that we make. Which means, given the information that we already have, theoretically, if we produce the maximum amount of barrels we could, we should allocate out budgeted fixed overhead of $6.50 to each barrel, and $7.86 for practical, and $9.78 for normal. For variable, well, it stays exactly the same. It's $30.20 per barrel. So theoretically, our total manufacturing overhead that should get allocated to each barrel, if we produce as much as we possibly could, is just equal to those two together, $36.70. Practically, if we operated safely and maintained our machines and produced as much as we could, we'd only be allocating $38.06 to each barrel. And if we consider our customer demand for normal capacity, we should allocate $39.98 to each barrel. Let's determine our fixed overhead costs, which we are going to allocate. And to do so, we're going to take our actual production volume and multiply it by our budgeted fixed overhead per barrel. Well, our actual production volume is 2,670,000 barrels during the year. Under theoretical capacity, we would have allocated 650 per barrel. Under practical, it would have been 786 per barrel, and under normal capacity, it would have been 978 per barrel. Well, if we multiply that out, that means that if we use theoretical capacity, we would have allocated $17,355,000 worth of fixed overhead to production. Practically, we would have allocated $20,986,200 to production. And if we use our normal capacity, we would have allocated $26,112,600 to production. So as we can see here, sure, theoretically, we could have made about 4.3-ish million barrels. We didn't even come close to that. We made 2.67 million barrels. So we would have severely underallocated overhead. But we have the option of choosing that if we wanted to. And we could just write off that variance later, which we're going to get to in a minute. Determining our fixed overhead costs allocated here, back to our information. Our actual fixed overhead costs were $26,700,000, and it didn't matter what denominator level capacity we chose. Our total fixed overhead allocated under theoretical would have been $17,355,000, would have been $20,986,200 under practical, and would have been $26,112,600. So if we chose theoretical capacity, we would have had a whopping production volume variance of $9,345,000. We would have severely underallocated overhead. Under practical, it would have been $5,713,800 for our variance. Still pretty bad. And then under normal, we would have had an underallocation of $587,400. So, absorption costing income statement that we have here. We're going to figure out what we will report as operating income if we chose each one of these different capacity denominators. So, let's start with our revenues. Our beginning inventory was 0, but we produced 2,670,000 barrels during the year. However, we had 210,000 of those left at the end. So it's safe to say that we sold 2,460,000 barrels during the year, and if we sold them at a sales price of $47, we got total revenues of $115,620,000. And this doesn't change based on what capacity we use, so we're good. We're going to report that for revenues on our income statement regardless of what capacity we choose. For beginning inventory, we're a new company, so that's going to be 0 as well. Our variable manufacturing costs, well, those didn't change either. We had $80,634,000 worth of variable costs. Fixed overhead allocated, however, is a different story. Well, as we went and we did our chart, under theoretical capacity, we would have allocated $17,355,000. Under practical capacity, we would have allocated $20,986,200. And under our normal capacity, we would have allocated $26,112,600. So our cost of goods available for sale is always beginning inventory, plus your variable manufacturing cost, plus your your fixed overhead allocated. Our cost of goods available for sale under theoretical capacity would be $97,989,000. It'd be $101,620,200 under practical, and it would be $106,746,600 under normal. Well, let's deduct out our ending inventory. And to figure out your ending inventory, you're going to take your ending finished goods inventory in units and multiply it by your manufacturing overhead per unit. We figured out our total MOH per barrel. Underneath, theoretical capacity, it was 3670, and if we take that 3670 and we multiply it by the 210,000 barrels that we have in ending inventory, if we use theoretical capacity, we would have inventory with a value of $7,707,000 at the end of the year. For practical capacity, we are allocating total manufacturing overhead of $38.06 per barrel. So let's go and multiply that by the 210,000 barrels we have in ending inventory. It means we would report ending inventory of 7,992,600 at the end of the year. And then for normal capacity, we were allocating $39.98 of overhead costs to each barrel. Well, if we go and we multiply that by the 210,000 barrels we have in ending inventory, our ending inventory would have overhead allocated to it of 8,395,800. Now we got our adjustments for variances, and that is what we just figured out on the last slide. Under theoretical, we would have had a variance of 9,345,000. That would have been an under allocation, so we would have to add that to our overhead. Practical capacity, we would have had an under allocation of 5,713,800. Again, that's an under allocation. That would increase our COGS. And then under normal, it was 587,400. So under theoretical capacity, we would have cost of goods sold of 99,627,000. Under practical capacity, we would have cost of goods sold of 99,341,300. And under normal capacity, we would have had 98,938,200. Gross profit is always revenues minus COGS. So under theoretical, it's going to be 15,993,000. Under practical, 16,278,600. And under normal, 16,681,800. And then lastly, we have our non-manufacturing costs, which we can go and we can take from our information, and our information tells us we didn't have any. For some reason, Jacksonville Brewery has zero non-manufacturing costs. They don't advertise, apparently, meaning our operating income is going to be the same as our gross profit. So what is the point of all of this? It's the same deal that I've been preaching this semester, and if you've had me before in semesters past. Companies look for ways to lower their operating income so they pay less taxes. So if you are theoretically if you're distributing overhead to the theoretical amount of units that you possibly could, you're going to have less value in your ending inventory that you didn't allocate to it, and instead take a bigger adjustment, which is going to give you a higher cost of goods sold and therefore a lower income. If you go to practical, well, now your ending inventory is less because you allocated less overhead to it, and you would be able to expense out that adjustment if you're going to use the right off the COGS method, recording, more coming in from adjustment. It's going to lower your COGS to 99,341,300, giving you slightly higher operating income, but not as high of operating income as you would have under normal capacity. So essentially, if you want to report the lowest operating income you can, you should choose your theoretical capacity for allocating out overhead to your goods, and then just write off the COGS that big under allocation that you had. If you want to have the highest income, well then allocate out at a number that is practical that you think you could actually have. You're going to have more cost in your ending inventory, higher asset level, but you're going to have to report a higher income because you're not writing off as much from that adjustment using the write off the COGS method.